Ja, hier van boven. Het is een beetje moeilijk, maar ik zal het sowieso ook assisteren. Ja.
All right. Um, Good evening, everyone. We will start the Zoom session within 3 minutes. We'll give other students a little bit more time to join the session. And then at 25 to 8, we'll start sharp on time. All right, good evening, everyone. I hope everyone was able to join the meeting. I hope everyone can hear me as well. We are delighted to have everyone tonight, especially our guest speakers, Stefan de Splanke from BlackRock and Johan van Overveld, who is part of the European Parliament and the European Budget Commission. First of all, maybe a little bit of an introduction to Captant. I guess most of you do know each other. But I will explain a bit how the second semester will take place. All of the events will be online for the upcoming semester, but we have some very interesting things planned. The beginning of March, we will have an evening where we will talk about ETFs, how to invest in those, and how to look for opportunities. The week thereafter, there will be an event on real estate. Very interesting because real estate is mostly seen as a property or an asset that only older people can invest in, people with a bit more money. And we will try to look for investment opportunities for younger people with a little bit less money as well. In that week as well, we will have an event on the different topics within finance. So think of investment banking, private equity, venture capital, a CFO, what else, asset management, and so on. So a short introduction given by experts in the field. Then 2 weeks before the Easter holidays, we will have a very hot topic on shorting. What exactly is it to go short on stocks? And some anecdotes on GameStop as well. So I guess many people will be very interested in this event. And then after the holidays, we will have at least one more event where we'll look at the legal aspect of finance, maybe a bit of estate planning, tax evasion, and these kind of things to see how the financial world copes with that. So for tonight, I guess most of you know what this is about. We want to see how President Biden, the Brexit, both relate to the Belgian economy and also to the global markets, and what this could mean for the stocks and the assets. So without further ado, normally I would say a big welcome and a big round of applause for Stefan de Splanke, but I will just give the floor to Stefan, and I hope you all have a very interesting evening.
Good evening, boys and girls, ladies and gentlemen. I hope you hear me well. I'm actually in Leuven again after so many time, and it's good to be out of the house again to talk to you and to give you a little bit more our views, the BlackRock views on the US elections, and specifically then the impact on financial markets. As I said, it's good to be back in Leuven. I graduated in '92. Most of you were not born yet. I graduated in TEW, dus toegepaste economische wetenschappen. And I ended up in the financial sector since in the 90s, and I'm still in the financial sector. The last 20 years, 21 years, I'm in asset management. First 4 years at Schroders, a British fund manager or asset manager, and the last 13 and a half years working for BlackRock, and where I'm responsible for the wealth distribution in Belgium and Luxembourg. I will not introduce BlackRock. I think as passionate members of Capitant, I think you know what BlackRock does, what we are doing. We are still the biggest asset manager in the world, but you see that in headlines, but that's not the most important thing. The most important thing is that we are a fiduciary for our clients, and that we manage a lot of money, 8,600 billion end of December last year. But this huge amount of money is managed for our clients, and our clients is more B2B. So we don't have private individuals or private investors as a client. Our business model is distributing our ETFs, our mutual funds, but also customized portfolio solutions to distributors, to private banks, retail banks, insurance companies, pension funds, even corporates. So every professional who has money to manage can rely on BlackRock in order to manage their money. I myself, I'm in Brussels. So we have 16 people, 16. That's a smaller office. In total, we have 16,000 people around the world. Belgium is a smaller office. There are no fund managers or analysts in Brussels. It's purely more a commercial office where you have marketing people, also public policy people, support people, operational people, sales people. Most of the fund managers and the investment teams are located in the let's say the big cities around the world, like New York, like London, Hong Kong, Japan. So we have, I think, investment professionals around the world, around 2,200 sitting in the city or based in the area or in the city where they manage the money. I will talk this evening for the next 25 minutes on the US elections, what happened, and the impact on financial markets. But not only that, more a broader view on the outlook that we have for 2021. And the outlook is basically a result also of the US elections, and most of our views on certain asset classes and certain regions, they are related, of course, to the result of the election, and specifically also the democratic sweep in the Congress in January. So that changed a bit our views. If you look at, and I'll try to go to the first slide, but I need some help here. Yeah, okay, thank you. The slide is called a new investment order, and it will become clear what that means. We have three teams that BlackRock Investment Institute, so the think tank that we have in our firm, three teams that we have put forward for this year. First is the new nominal. Secondly, globalization rewired, and the third one is turbocharged transformations. We are quite positive on equities, on financial markets for this year. We have basically in most of our portfolios a pro-risk stance, because we see stronger growth. If I look at some numbers, for instance, on the GDP, what happened last year, in the Q4 of last year, the GDP of the US declined with 2.5%, Eurozone 5%, Belgium 4.8%, and for even in the Q2 2020, so the quarter April, May, June, GDP went down, even in Belgium 14%, on an annualized basis, Eurozone 40.7, US minus 9%. So we really had one of the most severe corrections or most of severe recessions that we had, economically speaking. But we don't consider that as a normal business cycle. We compared it more to like a natural disaster or a shock where you have a deep recession, but followed with a steep recovery. And the fact that with the vaccine rollout and end of lockdowns and the beginning of mobility and activity again, that we could see stronger growth and even pent-up demand that is coming from households, and that will benefit more traditional sectors. So the stronger growth scenario will be very powerful, but it will not be accompanied with raising rates. As you know, if the interest rates rise and if inflation will increase, then you tend to have increasing yields and interest rates. That will happen, and we've seen that in the US, that the 10-year Treasury is already up to, I think, 1.35 now. But if you look at previous recessions, the inflation expectations are rising, but the nominal rates are rising less. So that means that the real yields are lower. And that's very positive for markets, for financial markets and for equities in specifically. So the new nominal is, we have inflation expectations. Inflation, we expect, will rise gradually. The growth will be quite strong, but the nominal yields and the nominal interest rates will be under control. It will rise, but not as much as inflation expectations, because the central banks will try to keep the nominal rates, I wouldn't say stable, but under control, because if nominal rates are rising, then it will have an impact on mortgages, on investments for companies, etc., and that they want to avoid. They want to avoid that so that they are not basically hindering the economy and the recovery coming up. Globalization Rewired is the second theme. And yeah, you've seen that globalization has come a little bit under pressure. We wouldn't say that there will be a globalization or deglobalization entirely. It will change. The globalization will change, and it will be much more focused not purely on efficiency and on costs, but also on resilience. That means that some of the supply chains will be perhaps more localized instead of more globalized. That will have an impact on geopolitics, whereby we see more of a bipolar world between US and China. And we feel that in investment portfolios that China deserves an increasing part of the portfolio, whether it's a fixed income or whether it's equities. You see the strategic implication on the slide. Country diversification is very important. So it's not purely about investing in Europe or the US or emerging markets. It's more about in which country and more granularity in that country diversification. Also, the China exposures that we have in the portfolios will be more above benchmark because of the fact that they are more of a diversifying factor within a portfolio due to the geopolitics. On the tactical side, and you see strategic and tactical. Strategic is a longer term, 5 years, 10 years and longer. Tactical is more our views on 6 to 12 months. And there we favor emerging market equities, specifically Asia ex-Japan. And now we have become neutral on Europe, still underweight on Japan, but neutral on Europe, given the fact that the vaccine, if the vaccine rollout continues as it is now, that we might have end of the lockdowns and that we have an activity restart again in Europe, and therefore we are getting more positive on Europe. The third one is turbocharged transformations, and that is a very important theme, because if you have one tendency or one trend that has come up during COVID, it's about sustainability. We've seen across the world at BlackRock in our ETFs and also in our active funds, an increasing flows into sustainable propositions. And I will come to that later on, but it's a very strong, powerful trend. Rising inequality, we've seen that as well during the COVID crisis or the Corona crisis within and across nations. That will also have an impact on these localized supply chains and on more a bipolar world. And the dominance of e-commerce at the expense of traditional retail. I think that speaks for itself. Even myself at my age, I order every week now 1 or 2 things that I buy online, which I will never have done before COVID. If we go to the next slide, and I already explained that, we consider COVID-19 as a natural disaster shock. What is important is the shortfall in terms of GDP, the cumulative shortfall. That means that if you go down in GDP due to COVID, what is the cumulative shock even the years after that, compared, for instance, to the global financial crisis? And there, a lot of estimates are that we would have a cumulative shortfall of GDP the following years of only 20–25%, sometimes even less. So we had quite a recession and a quite big shock. The world or the economy stood still for a moment, but the recovery afterwards, when the lockdowns are over and when everything returns to normal, this boost in economic recovery, or this boost in the economy, will be huge, and that will have an impact on financial markets as well. The reason why Capitan asked me is to speak about US elections and the impact on financial markets. It's important to, let's say, to have different scenarios. This slide was made in November, October, November. So we didn't know what the outcome of the Congress would be in January. And there you see different scenarios. A unified democratic control, the first line, a divided government with Biden as president and Trump as president. So we can eliminate line 2 and 3. It's now line 1. So we have a democratic control, although quite small, but there is a majority, and Biden as president. And the 5 pillars that are important and that are very important and that will have an impact on the financial markets are fiscal stimulus, public investment, taxation, regulation, foreign and trade policy. If you see a plus, that means that it's positive for risk assets. Risk assets are equities, corporate credit, private equity, you name it. If it's a plus, then it's positive. If it's a double plus, then it's really a boost. If it's a minus, then it's just the opposite. Then it's not so very good for equities in general. And the fiscal stimulus is an important part, because if Biden is president, and there is a majority or a democratic sweep in the Congress, then it will be more easy to boost, let's say, the economy with fiscal stimulus. And the main theme in his campaign was also sustainability. So he wants to invest a lot in green infrastructure, in sustainability in general, in clean energy. So that will boost the assets related to clean energy sustainability. We have seen some numbers on the exact amount of fiscal stimulus. I have to look at the numbers here. Sometimes they say 3 trillion for the next 4 years, 3 to 5% of GDP. The exact number, I don't know. You can do magic with numbers, but it's imperative that it will give quite a boost to the economy. Not only fiscal stimulus, but also public investment. And the investment will be there more in the areas of housing, transportation, and clean energy. If you travel to the US, everybody will notice that the infrastructure there is quite old. And Biden, in his campaign, told that he would like to spend much more, not only on R&D, for instance, but also on green infrastructure in general. Taxation is a negative, and regulation as well. And taxation, why is that a negative? I think now the corporate rate in the US is 21%. We've read somewhere that it would go up to 28%, that perhaps they would increase the marginal tax rate for the income tax as well. And that means that corporates, companies will get higher taxes. That will be a negative for equities. If big companies and mega cap companies have higher taxes, that will impact the bottom line and the earnings, of course, and that will be not so good for equities. We think that taxation is one thing, but regulation is another. And given the fact that he is focusing so much on sustainability, on clean energy, on also transportation, which he wants to reduce the carbon emission, that regulation together with taxation could be more of a negative for equities, specifically on specific sectors, meaning healthcare to a lesser extent, but specifically energy and technology. And you know that last year, one of the sectors that had the best performance was technology, the mega caps, because of the fact that everybody was basically in the house and using digital tools. So technology sector benefited from that. But it could be that these companies could be under more scrutiny in terms of regulation, antitrust laws, for instance, or data privacy policies that Biden could impose. Also on the taxation side, that would affect also mega cap companies or bigger companies. On the foreign and trade policy as a last point, that's a positive. Why? With Trump, he was very unpredictable. With Biden, we foresee and we think that he will have a more predictable policy and a more predictable stance towards China. Don't get me wrong, the bipolar world China-US will still exist. There is, with Republicans and also Democrats, there is a joint support to, let's say, to have a stance against China on human rights, on the technology dominance, on specific aspects. That will not go away, but his tone of voice and his diplomatic nature and his predictability will be positive for the relations and will have less of an impact on emerging markets or on China assets, for instance. In that case, and you see that on the right, what are the market implications? We have sort, and we call it a barbell approach. That means that we still like technology stocks. We still like healthcare stocks, quality stocks in general, because quality stocks we are quite positive on, companies with a good return on equity, not so much debt on the balance sheets, good cash flow, not if you don't have a lot of debt, you are not so sensitive to rising rates. These companies will continue to do well. But on the other hand, there is an increase in our weighting towards global cyclicals, domestic small caps. Domestic small caps are less impacted by tax increases, for instance, and will be more impacted by the domestic demand in the US, for instance. Cyclicals, what do I mean by cyclicals? That is industrials, commodities, consumer discretionary. What is consumer discretionary? Auto producers, restaurants and hotels, luxury producers. These kind of sectors are strongly driven by the economic recovery and by the demand from consumers. And there we are quite positive. Once the vaccines, once the rollout is successful and the lockdowns are over, we think that a lot of consumers will, with all the savings that they did last year, that they will start to consume again at a higher pace, travel again, buy more things, which could have an impact on these kind of sectors. Sustainable assets may get a boost as well. Why? And I said in the beginning that President Biden would like to focus much more on on sustainability in general. So everything that is related, or companies that are related to clean energy, renewable technologies, for instance, electric vehicles, all these kind of companies that are indirectly or directly related to this mega trend and to clean energy and the net zero world in 2050, they will get a boost as well. And we think that it's not yet in the price. So sustainable assets still have a way to go. At some point, all these assets, it will be in the price and they will get expensive, but that will take, in our view, a couple of years, 3-4 years, until we see that the premium that they have now will disappear, because it will be in the price. And I see that in my day-to-day job as well. We have much more demand from our clients for sustainable assets, but it's still, if you look at the overall picture, quite limited. Another implication for the markets is if you have a lot of fiscal stimulus, if you spend a lot of money, then you might have inflation. And we think that inflation expectations are underestimated, so that inflation can rise going forward. And that's why we are not very positive on nominal government bonds. You know that in a portfolio, you have a lot of equities, but on the other hand, a lot of investors have still bonds, fixed income, as a sort of a diversifier within the portfolio. If nominal yields are rising, the yield curve is rising, then it's not so good for these nominal bonds. So instead, we are much more focused on inflation-linked bonds than on nominal bonds, because of the yield curve could steepen, which will be positive for banks, for instance. It could steepen. It will not steepen that much, because the central banks will keep a lid on that rise of the yields in order not to hinder the economy too much. But as we've seen in the last couple of months, the yield on the US Treasury has increased from, I think, 80 basis points to 1.3, 1.4. But inflation expectations have risen much more. They have risen 1.2%. So you see that the nominal yields are a bit more under control. But that doesn't mean that inflation will not come. We think inflation will be there. Also, given the fact that we will have much more localized supply chains, and the costs that a lot of companies have to do in order to control the virus and to take precautionary measures, these costs will increase as well. So companies will have much more costs, and if you have, let's say, pricing power, then you might end up raising your prices for the end consumer. So we think that inflation could rise, and if you want a number, we think in a couple of years that the inflation could be between 2.5% and 3%, which is still not a huge inflation, but compared to where we are right now, it's an increase. I'm looking at the time because I don't want to surpass my time. US elections impact on financial markets. I already said that, I won't go into detail. If you look at the US electricity generation by major energy sources, then you see that the part of renewables is increasing. In 2010, it was around 10%. In 2019, it's already risen up to 19%. So that's also a theme of President Biden, is let's say on the electricity companies, is to not impose, but try to motivate and incentivize them to use much more renewable energy as a source of electricity generation, which will be positive for assets and equities that are related to this renewable energy sources. And that can be very broad. It is not only about wind and solar, but it can be energy efficiency. It can be companies that are delivering components for smart buildings, for instance. It can be charging infrastructure for electric vehicles. So every company that is related to, let's say, a reduction in the carbon emission in the world will eventually benefit from that trend. What is important to notice here, and that is a slide where I show the flows into exchange traded products in the US. So exchange traded products, the most known category is ETFs, trackers. You have others, but ETFs is, I think, more than 90% of the ETPs. These flows just before the election pointed already towards more consumer discretionary, more industrials, that's the top line, and more materials, that's the green line. So investors anticipated the months before the election that if Biden would win, that it would be a boost for more the traditional sectors of the economy. Like I explained, consumer discretionary, industrials, materials, etc. And you see a sector rotation the last couple of months, going from technology, healthcare, and these are called momentum stocks, towards these traditional sectors of the economy who will benefit, or which will benefit from a strong economic boost or a strong economic recovery. And when I drove to Leuven this evening, I heard on the radio that yesterday I knew already, but today that the technology stocks had a bit of a decline as well. So given the stronger valuations in these mega cap technology stocks, you see that the investors are rotating a bit out of these companies towards more traditional companies or value-oriented companies. What we also see in the flows, also since the election, is much more small caps than larger companies. Why? Because if there is an economic boost driven also by consumers, mainly domestic, then smaller companies will benefit more than the huge, bigger companies that are more reliant on exports, for instance. So the domestic demand, if that increases, then these small and mid-cap companies will benefit surely. If you look at the first theme that I explained, and I already mentioned that in my presentation, we still, or the world economy is still very much dependent on monetary support and fiscal support. That will continue into 2021. That was one of the reasons after March last year that stock markets bounced back very quickly, because the central banks all over the world, they committed to investing a lot of money in the economy on the fiscal side. That was different from the global financial crisis, together with the monetary side. And this duo is very powerful, and that will continue because the economy is still quite fragile. And they want to avoid that in the next couple of months, if you don't give support, fiscal support to corporates and companies or households, that you will end up with more bankruptcies. If you have more bankruptcies or consumers that cannot pay back their loans or mortgages, for instance, it would have an impact on the financial sector as well. And they want to avoid that. They want to bridge the temporary shock of COVID with fiscal and monetary support in order to, let's say, to support the economy. And once vaccination is over, once the lockdowns are over, then the economy can recover, still with the fiscal and the monetary support from the central banks. On the equity part, on the US, I said that the barbell approach is quite important. So on the one hand, you have quality stocks, technology and healthcare. We are still positive on these stocks. Don't get me wrong, technology is a mega trend that BlackRock defined, I think 2 years ago, which will impact the way we live, the way the society will operate for years to come. And technology as a long-term sector is, we are quite positive on. But there will be more of a focus on subsectors within technology, not purely the FANG stocks, as you all know, but more towards semiconductors, for instance, or software, or companies that are benefiting from the 5G technology. So it will be more fragmented within the technology sector. It will not be purely about the 5 big technology companies. And given the fact that regulation could increase, or that taxation could increase, these bigger companies will be more impacted than other technology companies, for instance. So information technology is quite important, and the US has a lot of information technology companies, but it will be more fragmented towards different subsectors. Healthcare is also quite present in the US, as you can see, is a top chart in the US, is also important. And we think that even when the regulation would increase on the healthcare sector, and the healthcare sector is quite driven by regulation, given the fact that it's an important player to, let's say, to control the COVID crisis. In the first year of the presidency of Biden, we don't expect a lot of new regulation or quite scrutiny on the healthcare sector for the time being. That could come up later, but not right now, because they are very important for vaccine production, etc., etc. Within the healthcare, we are much more focused on, for instance, biotechnology, medical devices, than really the large cap pharmaceuticals, because there you have a lot of patents who expire, and the pipeline of new products is going down, and that will impact a bit the valuations on these large cap pharmaceutical companies. If we have large cap pharmaceutical companies, it will be more in Europe that we are looking for opportunities than in the US. So that was the first theme. A couple of slides to conclude on the second and the third theme. China is an important part of a portfolio. And I say this with great importance because in practice, if I look at a lot of portfolios from our clients, and then the portfolios of basically the end clients who are a client of our client, because we are B2B, then you see that emerging markets in general, or Asia, and specifically China, are underrepresented in portfolios. And I know there are some risks of investing in China. You have a lot of debt. The statistics coming out of China, you can question that, if that is always true or not. But if you look at the weight of China in the world GDP, it's increasing. You see that on the right-hand side. If you look at the GDP forecasts on the left side, then you see the shock of last year. But the forecast is that they are practically on track, or even they recovered completely, and they are on track just before the COVID crisis with their GDP growth. So they are very resilient, and they've weathered the economic storm last year quite well. They came out of the COVID crisis much quicker as well, and it's more now back to business, and you see that in a lot of indicators. So China is doing very well economically. The increase in the world GDP is important, and also the weight of China in equity indices, but also fixed income indices, is increasing. China is opening up the capital markets more and more, so that if you have an MSCI emerging markets, for instance, that the part of China within an index will rise. So if that is the case, every ETF or tracker that is following that index will have to buy China as well. So basically, it will have a catalyst if China opens up the capital market to foreign investors, whether it's fixed income or equities. So that's an important part. And that I already explained, an increased focus on wealth and income equality. That is also, let's say, a result of COVID, and that will have an impact on, let's say, specific countries and the country diversification within a portfolio. To put it very simply, just having a globally diversified portfolio with some Eurozone, US, emerging markets, Japan, will not cut it in the next years, you will have to be more granular and more detailed in selecting the right countries and the right sectors and the right exposures within a portfolio. And that will be important. I didn't say that if we expect a strong economic recovery, that every company within the traditional sectors, within the cyclical sectors, industrials will do well. You need to be very selective, because not every company will do well, and that selectivity is much more detailed than before. And also, and that's the last point that I want to raise, is sustainability. We are a fiduciary asset manager, so we have to manage money for clients based on their objectives and their needs. We have different types of clients all over the world. We have US clients, we have Asian clients, we have European clients, we have a pension fund, we have a private bank, you name it, and they all have different preferences towards sustainability. So it's very difficult with one product to satisfy the needs of everyone. Being a fiduciary manager means that we have to manage their money the best way we can. And that is not only risk and return anymore. That is a very important part, but the sustainability strategy of the companies will impact risk and return much more than in the past. And we think we integrate sustainability in everything that we are doing. Last year, Larry Fink, in his annual letter to CEOs, mentioned that it was his ambition at the end of 2020 to have an integration of ESG and sustainability in all the active portfolios that we manage. It has been done. End of last year, 130 investment teams, they do take into account sustainability data when they manage the portfolios. Whether it's E from environmental, which is the most known, but also social, data, and governance, of course. The social has increased a lot due to COVID. The well-being of the people that work for big companies, or smaller companies for that matter, the well-being is very important to attract talent and to be, let's say, if you have the right people that you can attract, it's not purely about the financials anymore, but about how does the company care about my well-being, my working environment, and then I'm more productive as well as an employee. So the S has become very important in the ES and S&G, and every company that we are investing in must demonstrate these characteristics. You can do that on the active side, because if a company does not take into account climate risk, for instance, or a sustainability strategy, then you can leave it out of the portfolio. An ETF cannot do this, because an ETF needs to follow an index that our client has chosen. So if a company in that index is not sustainable, we cannot let's say, sell the company. What we can do, and that's basically then a result of the fact that we are quite big and we have a lot of access to a lot of companies, we can convince boards and management committees to do much more on the sustainability part. And much more we've seen last year, that as a big shareholder of a lot of listed companies, sometimes we vote more and more against directors in the board who do not support or implement or have a sustainability strategy in their business model. Climate risk is an important part, because climate risk, we see climate risk as an investment risk. And companies must take into account in their long-term strategy how they will deal with climate risk in their corporate or their company activities. And it happens more than before that we vote against these directors or companies that do not have sustainability strategy in place, or do not have significant progress in that sustainability strategy. And we've seen much more than 2 years ago that our clients are demanding sustainability, not from a marketing perspective. Let's say I will exclude some sectors and then you have a sustainable fund, but really integrating sustainability in the analysis and the management of portfolios in order to create value on the longer term for our clients. That slide, and I will close now because I'm a little bit over time, is the structural trend that I talked about in the beginning, is the dominance of e-commerce. And we think even after COVID that people are now getting used to buying online, that it will continue and that it's a structural trend to take into account in the portfolio. I will stop here and perhaps see if there are any questions.
All right. That was perfect, I guess. A very broad analysis of the asset classes all over the world. I hope many of you got a very interesting thought on this and could make something out of Stefan's analysis and implement some of these thoughts on your own investments. Now, these were, so to say, the impacts on the asset classes. So let's go to the political side a bit more now and to the real economy with Johan van Overtveld.
Thank you. Thank you also, Mr. Desplanke, for the very interesting analysis and not only analysis, but also the conclusions to which they lead, of that analysis lead in terms of financial strategy, investment strategy. Capitan asked me to elaborate on what that would mean for the Belgian economy, which I'm glad to do. Now, the basic principle is quite simple. The Belgian economy, and certainly the Flemish economy, is one of the most open economies in the world. So if the world does a better job in terms of economic performance, that inevitably and for the good means that also the Belgian economy will be improving. There are a lot of uncertainties today. As Mr. Desplanke was speaking, I got the news that AstraZeneca announced that its second quarter deliveries of vaccines to the European Union would be less than half of what was foreseen, which of course means that this is again bad news from the vaccine front that will inevitably affect the sentiment and the economic forecasts for the shorter term. The outlook remains quite uncertain. But I think both Brexit and the Biden presidency have important consequences for the Belgian economy. Let me start with the Brexit, where the British market is the fourth export market for the Belgian economy, and again, more specifically for the Flemish part of it, and then even more specifically, the small and medium-sized enterprises, which in the Flemish region depend a lot on their export to the UK. A lot of issues still needs to be settled in terms of the Brexit agreement. There is a kind of general agreement, but with a lot of loose ends on the fishery issue, on the regulatory agreements, on also the financial world, of course, what the city of London, how it will be impacted and how it can in its turn impact mainland Europe. These are all things that still in which there are a lot of loose ends, let me put it that way. Now, an often neglected element in the discussion on the Brexit is that in the meantime, and although there has been some backward movement in just recently, there has been, of course, a severe or a serious devaluation of the British pound in the slipstream of the Brexit saga, which, by the way, has been going on now for more than 4 years. And that is, of course, a serious disadvantage for mainland Europe companies, and certainly also for the Belgian export sector. and of course, an advantage for the British sector. And I heard already several Belgian entrepreneurs contemplating the idea that given the very attractive rate of the British pound, production in the UK might become more interesting, which then would, of course, be what we call an unintended consequence of the Brexit decision. But so here the conclusion is quite is as simple as it is complicated. A lot needs to be settled in the coming weeks and months on the Brexit issue. So far, so good, between brackets. I expect that things will be sorted out slowly and hesitantly, but in the end sorted out. And so the fear of a hard Brexit is gone, which is, of course, for the general mood and the general expectations, a good thing. And then the Biden presidency, where I think Mr. Desplanque called his presentation New Investment Order, I tend to argue that we may be entering a new political order too. And let me explain that, because that has also complications for the Belgian economy, whether this new political order comes through and in what final version it comes through. First of all, I think with President Biden, we have a back to normality change. I think the Trump presidency was a disaster. Erratic behavior, confrontational behavior made things very unpleasant for the United States, and even more so for the United States partners in Europe, in Asia, and elsewhere in the world. A lot of trust was lost. And I think in the first few weeks of his presidency, Mr. Biden and his team have already come some way in restoring that. And I really applaud that. I think it's going smoother than I expected. That's important because obviously the United States is still the leader, the guardian of the liberal world order, a guardianship that the United States was about to lose, and all the rest profiting from that liberal world order were also to lose during the Trump presidency. But that has not happened. And the lines are redrawn now. And they are withdrawn on different fronts. And certainly, with respect to China, Mr. Trump was also quite, or should I say, adversary vis-a-vis China, but in a very confrontational way. I've never understood why he came close to a trade war with China, and there were reasons to go in that direction, but at the same time, he was fighting with the Europeans on trade. It would have made much more sense that Europe and the United States would have confronted China together. And this is what we see happening now. What, as far as I know, has not yet hit the news, but is extremely important, is that in June, we will have a G7 meeting, that is the United States, Japan, Canada, the UK, Germany, France, and Italy, let's say the 7 traditional major economies, will be meeting, and they have invited India, South Korea, and Australia. And these 3 countries have immediately accepted. So we are evolving to something like a G10, but with a very important presence from the part of Asia and from some of the most important neighbors of China, India, Japan, and South Korea. This is something that Beijing hates, really hates. Believe me, the China attitude, especially under President Xi, has been to try to divide the West. And up till now, they succeeded magnificently in doing that. But with the Biden presidency, and I think I can tell you for sure that the major European policy or politicians have very well understood the message. The democratic West, if I may put it that way, is closing ranks. That's great news, because indeed we have to show China where the borders are of what they can do. They cannot join the world economy and try to dictate their will on that world economy, which is obviously what they have been trying to do, and that they, if left on their own, would try to do even more in the coming period. But it's too early to call it already a big success. We see a fundamental change in the attitude of, let's say, the rest of the world under the leadership of a new president in the United States, with the G7 going in the direction of a G10. And of course, for China, it's quite another thing to have to confront these 10 countries if indeed they can come to a unified approach, which of course is certainly not yet there, but is certainly getting closer. So this might become more confrontational because obviously China doesn't like it. That's also the reason why just before the new president of the United States was put in office, they agreed on an important trade and investment agreement with Europe. China prefers to deal with Europe and separately with the United States and other countries. That's very important. That's maybe purely political, but it will have huge economic and financial consequences if this trend, which is young, which is still fragile, I admit it all, but if this continues, this might really be an enormous game changer. Another point on which the Biden administration, I think, will be important, or the American attitude in general, is with respect to what they will do or not with the big tech companies. In Europe, Commissioner Vestager has been very outspoken about these companies. I'm of course talking about Google, Amazon, Facebook, Apple, those companies, because of course they've been usually successful. They've been impressively, not to use another word, profitable, but there are side effects, and these side effects have become quite important. We see clearly monopoly or quasi-monopoly elements. And that's of course very worrying, because what this means is, first of all, that to put it in a very popular term, consumers are ripped off. That's the definition of a monopoly. But also that we see a negative impact from these companies on further innovation and research and development. Some economists have already been arguing about the fact that these companies, or the tendency that these companies are moving in what they call a kind of killer's zone, where whatever new initiative or development pops up, they try to buy it, and they are so loaded with cash that they can buy almost anything, or whether either to kill it or to take it on board and integrate it in their own system. That's not good for economic development in the longer term, and we certainly have to find a new equilibrium here, where of course the innovative capacity of these companies needs to be recognized, needs also to be rewarded, but where we have to get rid of these monopoly and quasi-monopoly situations. We cannot do that by a digitax. I think that's a very stupid thing, where the whole of Europe has been crying for. These companies will laugh with this, because You can take 10 or 20 or 30 billion from them, but they won't they will hardly feel it. And given the fact that they are monopolies and quasi-monopolies, they will just adjust their pricing so as to recuperate these taxes. It's in the open. What the Biden administration will do? Will they join Europe in antitrust cases, antitrust initiatives vis-a-vis these companies or not? It's an open question. It's not very clear what they will do. And of course, a very important element, and linked to what I said earlier on the relations with China, it has become a matter of fact that these companies have become quite important for the military and intelligence community in the United States. And I can imagine, and there are clear signs that this is already a reality today, that from these circles, these military and intelligence circles, people are saying, watch out, because we need these guys. There was recently a very well-informed article on by a former CIA top-level guy, arguing that China is very anxious to, how should I say, to take Taiwan, but that they hesitate to do it because they fear the telecommunication power of the Americans might destabilize their entire military system at short notice. And that's, of course, something that is done in cooperation with some of the companies I've just been mentioning. So whether really the Biden administration goes for a kind of full-blown antitrust offensive vis-a-vis these companies, which on economic terms might be defendable, is put in doubt by the other more geopolitical considerations I've just been given. These are just a few ideas, a few tendencies that we see today in the world with respect to the Biden administration. Earlier, I spoke about Brexit. This will, of course, all have an impact on the Belgian economy, given its openness, but it's absolutely undoable today to start to say that this, how this will evolve and what will be the final result. Of course, in the shorter term, what happens to the corona pandemic will be the main determinant of how the economy will be going. I totally agree with Mr. Desplanque that there is a lot of pent-up demand that can burst out any moment if we get sufficient assurance that indeed the pandemic is under control. But like I said in the beginning of my talk, the latest news on deliveries, certainly for the European Union, is again quite negative or not really very positive. And so in terms of expectations and people running out of the room, in terms of being negative, being rather pessimistic about the future, is something that might be with us for somewhat longer than we foresaw, let's say, 1 or 2 months ago. That would more or less be it for me, because if I understood correctly, there would also be time for Q&A. Thank you.
Good, perfect. Thank you very much, Johan, for elaborating on the impact of the political scene on Belgium and on the other economies as well. We do have a few questions already. So let me see if I can read them out loud. For the other participants, you can also use the Q&A to pose some questions. We will be reading them out loud to our guest speakers. The first question that came in was, or goes as follows: why the city didn't come to Brussels and stayed at London? So I guess this refers to the big city, the
City of London.
I guess the city of London, while the financial center of the world stayed in London and didn't come to Brussels. This will probably be. Or is there someone raising a hand, asking to speak up? Because this was posed by Corentin Vera. So maybe if you want to elaborate on this, because I do not fully understand the question. Well, if Corentin Vera is not here, then I'll go to the next question. It's a bit too vague, maybe. A question probably for Stefan. What will be the impact on mergers and acquisitions due to Brexit? Very interesting question.
Yes, that's a very interesting question. But basically, we are an asset manager, so we are always looking at the fundamental investment case. If there are more mergers and acquisitions, that will mean that, yeah, some of the companies might have, let's say, how do you call it, efficiencies of scale, and could basically try to merge activities whereby the earnings for the future will increase. Because if you take over a company, you try to do that if it's complementary, or you try to do that to have economies of scale in order to grow market share and to continue or to increase your earnings in the future. If that would be the case, then it's case by case, and our portfolio managers are looking case by case. If basically the valuation of the company, if it's already in the price or not. If it's not in the price, then it could be an interesting company to put in portfolios. Let's say the whole discussion about mergers and acquisitions is interesting, because the fact that, and meneer Van Overtveld alluded to that as well, the fact that if you are taking if you do a lot of mergers and acquisitions, you sometimes become so big that you have more counter effects, or how do you call it, neveneffecten. But in order to grow market share, sometimes, in order to be more efficient, a merger and acquisition is the way to go. And we have portfolio managers within BlackRock who are specialized even in event-driven strategies, whereby basically you integrate portfolios or companies into your portfolio if they will acquire other companies in order to have these benefits or economies of scale.
Can I add something to that?
Absolutely.
Well, I think indeed this Brexit development might bring about some increasing merger and acquisitions in both directions. And there is already some fragmentary data or information pointing in that direction, because you have, on the one hand, like I pointed out, quite competitive production environment or activity environment in the UK, due to the low pound, due to the, in general, the business pro-business environment policies of the Johnson government. And on the other hand, you have, of course, UK companies who want to be assured of their presence on mainland Europe, and taking over a company, in my first example in the UK, in the second case on mainland Europe, might of course be an obvious way to achieve the respective goals. So I think Brexit bears, of course, conditioned upon a more positive general frame environment, the possibility that we might see more mergers and acquisitions, and especially acquisitions in the UK by mainland Europe companies and by UK companies on the mainland.
Right. See that did Linda try to share some information on Corentin's question. So maybe to rephrase it again, why do many companies stay within the UK as the free trade negotiations with Europe and Asia and the US have to be started yet for the UK, whereas the free trade within Europe with other nations is already set. So why would it still be interesting to be located in the UK?
Well, because several reasons. Like I said, if you can start from the platform UK as it is today, you certainly have a competitive premium on your side, and don't overestimate the market unification in Europe. It is there for industrial products, but it is much less for service products. There's still a long way to go before we have in Europe a unified market in terms of services. And since services are now more than 2/3, if not already 3/4 of the economy, that is of course something very important. So I think the attractiveness of the UK for a certain type of activities is certainly there, and the political world will do everything in its power to avoid a crash in terms of shutting down markets for each other. That's something where everybody realizes that everybody will lose, and politics might become quite crazy. I can assure you that it can become quite crazy in certain moments, but it does not become totally crazy. And that's why I think that indeed there might still be a good case to to develop your activities as a company in the UK, even if you have a pan-European point of view.
Okay, so still a few reasons to be active in the UK then.
Of course. Don't forget that the UK market in itself is, of course, also a very important market, right, in the European context.
Mm-hmm. Then maybe another question, the last question up to now, if there's no one else asking one in the Q&A. A question for Stefan. We see that the markets are still rising despite an economic crisis due to COVID-19. Many people start talking about bubbles. Many people fear that there is a bubble in the financial markets. And this is probably or mainly opposed because of that the central banks continue their quantitative easing and continue to dump almost a lot of money on the financial markets. So are we moving towards a bubble, or are we still far off?
That's a question that I receive quite a lot in my immediate surrounding. We believe at BlackRock that we are not in a bubble territory. Why not? Is that the stock markets have risen quite considerably last year. Now we've seen the last couple of weeks that it's more muted, but it was not across the board. I think if you look at the S&P 500, I think that 25% of market capitalization is coming from 5 stocks. And I think everybody knows the stocks. So it was a big concentration in specific sectors and in specific styles. you still have a lot of, and that's why the granularity and the country and sector diversification is so important, that you still find companies that are doing well, that will benefit once the COVID and that are still very cheaply valued. Emerging markets, for instance, is not very expensive. Technology, of course, is expensive. US is not cheap either. But sometimes the traditional metrics to look at that are used is price earnings, these kind of multiples. And if you only look at this, then you could say that some markets and some sectors are really in a bubble territory. But compared to the 90s, for instance, or the beginning of the years 2000. But you always have to look at one expression: is there an alternative? Tina, there is no alternative. The yields on fixed income are negative and so low that a lot of investors, also pension funds, will need to take on risk in order to have yield and income. So you don't really have an alternative anymore. And because of the fact that rates are so low and negative, if you put that into perspective with the valuation of stock markets, then I don't say that it's cheap. The risk premium, basically the thing that you get if you invest in equities, the additional return that you get is going down, but it's not yet at a minimum level because of the fact that the yields on fixed income and the rates are so low. So you have to put that into perspective. If there is no catalyst in the markets that could change this, and there are risks in the market, for instance, the budget deficits and the increase in the debt of a lot of countries could, if it's in the eye of the investor, perhaps suddenly create a fear, and that interest rates would rise. If nominal interest rates would rise very quickly and very fast, too much, then we could have a bubble, specifically also in the fixed income markets. And that would have repercussions on equity as well. But if central banks are managing to let inflation run a bit, I would say hotter, but they would let inflation increase without raising the nominal rates. Then if they master this and it's a balancing act, then that risk would be limited. So in a nutshell, or as a conclusion, some parts of the markets are stretched, but overall we don't see really a bubble territory.
Mr. De Planke, if I may, I respectfully want to disagree with you, because if the central banks
and then maybe
inflation...
one last question that just came
Sorry,
in,
may I intervene?
via our Instagram for Johan van Overveld. Or do you want to elaborate on this?
Yes, I want to elaborate on what Mr. De Planke just said, because I basically agree with your analysis of the equity market, where there are certainly corners or parts of the market that are in bubble. But what we have seen is a huge explosion of the tech equities. But we all know that the equity market is but a small brother of the bond market. That's where it really happens. That's where the financial markets really are made. The bond market is much more important than the equity market. The equity market is nice to talk about, but the real heart of the financial market is the bond market. And if in your scenario inflation increases without interest rate increases, then we will of course have a gigantic crash in the bond market, which of course the central banks can try to control by buying more and more bonds. What we've seen in Japan, where we now have literally, and BlackRock people certainly know that, days where there is no trading in government bonds, because there are so much bonds already on the balance sheet of the Bank of Japan. Now, that is of course feasible in Japan. That is impossible in Europe. That's the end of the euro area if that happens in Europe, because certain countries will never allow that the ECB start buying, and I think you can fill in the dots of the countries I'm referring to, huge amounts, and I'm talking about literally hundreds of billions of euros of bonds of certain other countries, which even by law, the ECB is forbidden. They have their capital ratios and their the way in which they have to divide between the countries to respect. So what we will see is increasing pressure on the bond market, certainly if inflation increases. I can assure you, in Frankfurt, everybody is that nervous about rising inflation because obviously that will oblige them to intervene and they will hit their limits very quickly. Now we can of course say a crisis will make for new rules. Well, wait and see. But the big problem that is, and there is, I'm convinced there is a huge bubble in the bond market with how many hundreds of billions negative yielding debt, which is of course crazy. Has never happened before to such an extent. And that can only be continued because of the policies of the central banks. And I remember vividly as a Minister of Finance that at one point I asked Mr. Draghi, that was in 2017, tell me, what is according to you the limit of the QE programs? And Draghi, who is always a kind of sinister figure, laughed at me and he said, well, Mr. When the entire euro economy is on the balance sheet of the ECB, then it's the end of the game. That's the way Japan is going. Japan is already actively buying equities, as you certainly know. Corporate debt, gigantic amounts. But of course, this cannot continue because we won't have an economy, we won't have financial markets, and we won't have an economy anymore. So again, in a nutshell, I agree with your analysis on the equity market, but that's not where the problem is. The problem is in the bond market. And the bond market is much more important than the equity market. Thank you.
I think this was a very interesting interlude on Stefan's analysis on the equity market. Many people probably will be shocked. So was I actually. I sort of knew that the bond market was overvalued, or that the negative interest rates are a huge problem to the bond market. And maybe to add to that, Johan, how is the role of the European Commission together with the ECB and the fact that all of the countries need money to overcome this crisis, basically, but on the other hand, the central banks cannot stimulate the markets and the economy too much anymore, because otherwise we will hit that point of no return where we will have maybe a failure of the euro. How is this this connection between the ECB and the European Commission?
Well, the system can go on as long as there is collateral in the economy that the central bank can buy, and that can have as the counter side on its balance sheet that they can create base money against. Whether that goes to the government or goes to the banks, whatever, that's the basic issue. That's the basic mechanism. You have a balance sheet of a central bank, and the asset side, as long as they can find assets which they can bring on their balance sheet, inevitably creation of money is the other side of the coin. They can continue. But the problem is that, and that's the big difference between, for example, the United States and Japan and China on the one hand, and Europe on the other hand, that the ECB is the central bank of still 19 independent countries. And what Italy wants is fundamentally different from what the Dutch and the Germans want. And what Spain wants is different from what other countries want. And so far, the ECB has been able to manage that. but they know very well that they are approaching their limits in terms of what they can do, and they cannot. Philip Lane, the chief economist of the ECB, was quite outspoken in the European Parliament last week. He literally said, gentlemen and gentlewomen, beware, we are approaching the limits of what we can do. And that's the reality that, that they are facing. And that's why they're so afraid of inflation, because if inflation starts to rise and they do not act or react or intervene, then we will have an enormous crash in the bond market, because there will be a huge rush for the exit, like we've seen in 2008, not in the bond market, but in other markets. That will be just the same thing. And if they can't act because of the limitations of their statutes, then we will have a huge problem. And of course, then we will convene again, night by night, Euro area, group ministers of finance, central bankers, etc., etc. But that will really be a mess, believe me. And so we better start. Of course, what we need to do is the only thing that can change us or that can take us out of this mess is economic growth. That's the way after the Second World War, the huge increase in the balance sheets of especially the American central bank has disappeared gradually due to some nice inflation, somewhat higher interest rates, and economic growth. And if we can achieve that, and that's why every central banker is so focusing on structural reforms, because that's the only way you can generate sufficient economic growth. That's the way out of it. And if we don't get economic growth, then we will have a crash in the bond market. Sorry to say, but
no, it's worrying, but we have to think about it, absolutely, especially the central bankers and the investment bankers and asset managers. But let's be a little bit positive minded. Suppose that we do not hit this limit, that there is still a bit room. So everything goes as planned, there is economic growth, but the assets on the balance sheet of the central banks somehow become worthless. I mean, there were many bonds bought from BBB rating and below that, so that is speculative grade. What would happen if these bonds become worthless?
Then the central bank will make a loss, and a loss will will reduce its capital, which in itself is not deadly, but which, of course, again in the European context, is of course a problem, because there will be a need to replenish the capital, and then you have to go to 19 different capitals.
Right. So also an.
And would you like to be the German politician who has to tell his people that, well, we have to increase the capital of the ECB because Italy has defaulted on its debt?
Certainly not.
At the end, it's a huge political problem.
Mm-hmm. Right, another question, Q&A, other people have found their way to the Q&A. Question to Stefan, I assume. So about the mergers and acquisitions in the UK, would this mean that there will be more IPOs and more companies going to the stock market via an IPO, or maybe via the SPACs, the special purpose acquisition companies that are getting more attention nowadays?
I cannot really comment on SPACs because within BlackRock, let's say we are fundamental investors, and I know the concept of a SPAC, but basically you don't know exactly, you invest money and you don't know exactly what you want to acquire. I've never come across investment teams or portfolio managers who are positive on SPACs. What I do know is that if there is some indicators of bubble territory, that would be in these IPOs and the prices that sometimes they or let's say the rises in their share prices sometimes that accompany that. I think if you look at the themes and the let's say the sustainability, clean energy, technology, etc., that IPOs are an important part of an economy, and you will have companies trying to do an IPO. But from an asset management point of view, if we invest in IPOs, and active funds can invest in IPOs, then it's really a fundamental investment case from the portfolio manager to see if that fits within the portfolio. And the SPACs will never be, in my knowledge, because I'm more of a generalist, I don't know exactly for all the details of the investment team, but I've never come across an investment team in reporting who says I'm invested in specific SPACs, or I'm very fond of the IPO market. So it's case by case basis, and it depends on the investment team and the portfolio manager. But to be honest, we don't have a house view at BlackRock. So every investment team has the flexibility and the autonomy to invest based on the investment case that is pretty much debated within the team, and is based on fundamental aspects. We do have some quantitative funds as well that are managed more on a quantitative basis, but it's always in correlation or in relation with a fundamental business case. And we do have portfolio managers who are, let's say, contrarian and who do not invest in IPOs anymore, specifically in specific sectors like in technology. But it's the fundamental investment case which is important.
Right. Then maybe one last question that came up in the Q&A now, referring back to what has been said and talked about earlier on the bond market. So suppose that we have a huge crash in the bond market. I assume that this will have an impact on the equity market as well. So either Stefan or either Johan, what would be the impact on the equity market initially and also in the mid and in the long term?
Perhaps I can start. It would have a serious impact. Basically, the analysis that I did, if I have questions on bubbles, I always talk about the equity market, because for specifically for young people, and if they want to invest, private individuals, they are talking much more about the equity market than fixed income. Fixed income is very much institutional, but it will have a huge impact. And I agree with Johan as well that in certain areas, specifically in the government bond market, that we have, let's say, we are in bubble territory. What would be the impact if, let's say, if you have a discounted cash flow method in order to evaluate stocks? If the interest rates rise, then you use that in order to value or to assess the fair value of a company. This fair value will go down related to the share price. So basically, the valuations will go up massively, and you will have a severe correction and a severe downturn in equities. It is related to the speed and the frequency, or let's say the speed and the timing of interest rate rises. If it's very gradual, then it will be much more under control. But if it's if it's a shock or a bubble, it can go up very quickly, and then the impact on equity markets will be very severe on the short term. But you need volatility in the markets for long-term investors. If you don't have volatility, you cannot have, let's say, the decent return. So asset managers need volatility. If you have a severe correction, that will create opportunities for companies that will be less reliant on interest rates and with a beautiful balance sheet and with less debt. These will go down as well, because the beta of the market will go down 20, 30, 40%, like in 2008. People who invested at the end of 2008 with beautiful quality companies, they have earned a lot of money in the years to come. So it will create opportunities in the long term, mid to long term, but on the short term, it will be quite severe. If central banks do not manage to, or are not succeeding in manage let's say, the rise of in interest rates.
I totally agree with this analysis.
Do you want to add something to that, Johan, or do you fully agree with Stefan's note?
It's difficult to add something sensible if you fully agree. So I think Stefan just gave a very precise or very accurate description of what we may expect in such a...
You have muted yourself again, Johan.
Sorry, like I said, I totally agree with Stefan, so I don't have much to add.
All right. Good. Then if there are no further questions from the audience, I think we can conclude here. First of all, a big thank you to our guest speakers, Stefan and Johan. This was a very interesting evening. Many different topics came up tonight. I hope the audience, the students enjoyed it as well. We are open to any questions in the future. Also to students who are interested in Capitant or joining Capitant, please just send us a message. We are opening our applications in the beginning of March. We are looking for a new team for the upcoming year. So if you do have any interest in our future events or in joining Capitant, let us know, and we are always welcome to have a chat. So that was it. Thanks again for joining us tonight. We hope you enjoyed it, and we hope to see you back another time.
Thank you. All the best.
Thank you very much. And then one last thing, of course, a big thank you and a shout out to our partners, thanks to whom this is also possible, of course. Right.